All right, so you're looking into monthly dividend stocks, specifically Realty Income and Agree Realty.
Okay.
And you want to know which one's the better bet.
Right.
It's a classic matchup.
Yeah.
Realty Income, the giant tortoise, slow and steady with a higher yield, versus Agree Realty,
Yeah.
the hare rapidly growing and potentially more rewarding in the long run.
Well, what's interesting is that both of these companies operate as net lease REITs.
Okay.
Which is, a key detail in understanding their strategies.
Now, I know net lease might sound like financial jargon to some folks out there.
Sure.
So
Yeah.
break that down for a sec.
Essentially, with a net lease, the tenant takes on most of the property's operating expenses.
Oh, okay.
So things like property taxes, insurance, even maintenance,
Wow.
all falls on the tenant, not the landlord.
So for the REIT, that translates to lower risk and a more predictable income stream.
Right, exactly.
So it's like a built-in safety net,
Yeah.
making net lease REITs attractive for income-focused investors.
Absolutely.
Okay, so let's dive deeper into these two contenders, starting with Realty Income, the giant tortoise in this race.
Right, and when we say giant, we mean it.
Okay.
Realty Income boasts a portfolio of over 15,400 properties
Wow.
across North America, and even dipping its toes into Europe.
Okay, so
That's diversification on a massive scale.
it's almost overwhelming.
It is.
All that diversification probably contributes to their boring is beautiful approach, which, by the way, I kind of love.
It's certainly paid off for them. They've increased their dividend every year for the past 3 decades.
Really?
A testament to their consistent performance.
Okay, that's impressive.
Yeah.
But let's get to the juicy details.
Yeah.
What kind of yield are we talking about here?
Hold on to your hats, because Realty Income is currently yielding a tempting 5.8%.
Wow.
And to top it off, they boast an investment-grade balance sheet.
Okay.
So essentially, it means they're a very low-risk borrower,
Right.
which translates to financial stability and peace of mind for investors.
So it's not just about the yield, it's about the sustainability of that yield,
Absolutely.
which seems pretty solid with Realty Income.
Yeah.
But they're not just sitting on a pile of generic properties, are they?
You're right. Their portfolio is primarily retail,
Okay.
which aligns with their focus on reliable income. Think about it. Well-located retail properties, especially those with strong tenants, are generally easy to release or sell if needed.
If needed.
But they've also got some industrial properties in the mix, and even some unique assets like casinos and vineyards.
Casinos and vineyards?
Mm-hmm.
Okay. Maybe the tortoise has a bit of a wild side after all.
Exactly. That sprinkling of unique assets adds another layer of intrigue to their otherwise boring is beautiful approach.
Right.
But now let's shift gears and meet the hare in this race.
Okay.
Agree Realty.
All right. Bring on the speed.
Yeah.
So how does Agree Realty stack up in terms of size?
Well, compared to the giant tortoise, they're significantly smaller,
Okay.
with about 2,370 properties. But that smaller size is actually a key part of their strategy.
I'm sensing a slow and steady wins the race versus fast and agile kind of debate here.
You got it.
Okay.
Agree Realty's smaller size allows them to be more nimble, adapt to market changes quickly,
Okay.
and potentially achieve a faster growth rate.
And speaking of growth,
Yeah.
I've heard whispers about Agree Realty's dividend growth being pretty impressive.
The rumors are true.
All right.
Over the past decade, Agree Realty's dividend has skyrocketed by a whopping 66%.
Wow.
That's significantly higher than Realty Income's 40% growth over the same period.
Okay. That's a pretty compelling argument for the hare,
Uh,
but there has to be a trade-off somewhere, right?
There is.
Okay.
Agree Realty's current dividend yield sits at a respectable 4.1%,
Okay.
which is lower than Realty Income's.
Right.
So you're sacrificing some immediate income for the potential of faster growth down the road.
This is where it gets interesting because we're talking about two different investment philosophies.
Right.
Do you prioritize current income or potential future growth?
Yeah,
It's like choosing between a guaranteed payout now or betting on a potential windfall later.
exactly.
Right.
And to make things even more intriguing, both companies focus heavily on retail properties.
Right.
But what's interesting here is the nuance within that focus.
Okay, let's unpack that nuance.
Yeah.
We know Realty Income has a broader reach with its diverse portfolio. But what about Agree Realty?
Yeah.
How do they approach the retail landscape.
While Realty Income casts a wide net, Agree Realty has doubled down on what they believe are the most resilient and adaptable segments of the retail market.
Boom.
Think grocery stores, pharmacies,
Right.
those businesses that are less susceptible to economic downturns or the rise of e-commerce.
So it's not just about being in retail. It's about being in the right kind of retail.
Exactly.
That's a smart strategy, especially considering the headwinds facing some parts of the retail sector.
Right.
But I'm curious, how do their financial metrics, beyond just dividend yield, compare? We're doing a deep dive here, so let's look under the hood.
You're right. We need to go deeper than just the surface numbers. Let's start with funds from operations, or FFO, which is a key metric for REITs.
Now, for those who aren't familiar with REIT jargon,
Yeah.
what exactly does FFO tell us?
Think of FFO as the REIT equivalent of net income for regular companies.
Okay.
It's a more accurate measure of a REIT's profitability
Okay.
because it excludes depreciation,
Right.
which can be a significant non-cash expense for real estate companies.
So FFO gives us a clearer picture of the actual cash flow generated by the REIT,
Exactly.
which ultimately fuels those dividends we all love.
Precisely.
And when we compare Realty Income and Agree Realty's FFO,
Yeah.
we see some interesting differences that highlight their contrasting approaches.
We do.
All right, I'm on the edge of my seat.
Oh, okay.
Lay it on me. How do their FFO numbers stack up?
Well, Realty Income, being the larger and more established company, boasts a significantly higher FFO overall.
Okay.
However, when we look at FFO growth rate, Agree Realty takes the lead.
Makes sense.
Remember, they're the hare in this race.
Right.
And their FFO growth reflects their aggressive acquisition strategy and focus on expanding their portfolio of high-quality retail properties.
So even though Realty Income has a bigger pie, Agree Realty's slice is growing at a faster pace.
Right.
That makes sense considering their size difference and growth strategy.
Mm-hmm.
But it also raises the question,
Yeah.
is Agree Realty's rapid growth sustainable in the long run?
That's the million-dollar question.
All right.
And to answer it, we need to look beyond just FFO and consider another crucial metric.
Right.
The payout ratio.
Okay, let's break down the payout ratio for a second.
Sure.
What does this tell us, and why should our listener care?
The payout ratio is the percentage of a company's earnings that are paid out as dividends.
Yeah, okay.
It's a measure of dividend sustainability.
Okay.
A high payout ratio, say above 90%, might signal that a company is stretching itself too thin to maintain its dividend,
Right.
potentially putting future payouts at risk.
So ideally, we're looking for a payout ratio that strikes a balance
Yes.
between rewarding investors with generous dividends while also ensuring the company has enough cash flow left over to reinvest in growth and weather any potential storms.
Exactly.
And when we compare Realty Income and Agree Realty's payout ratios, we see...
Oh, come on.
We'll save that juicy reveal
Oh, you're killing me with a cliffhanger.
in the next part of our deep dive.
All right, listeners, you'll have to stay tuned to find out how these two REITs stack up in terms of dividend sustainability.
Mm-hmm.
All right, so let's dive back into those payout ratios.
Okay.
Remember, we're looking for that sweet spot.
Yeah.
Generous dividends without jeopardizing the company's long-term financial health.
So who takes the crown for dividend sustainability?
Yeah.
Is it the tortoise or the hare?
Well, Realty Income, with its massive size and diversified portfolio, boasts a payout ratio in the mid-70% range.
Okay.
That's considered very healthy, especially for a REIT.
So that means they're distributing a good chunk of their earnings to investors
Right.
while still retaining enough to reinvest in their business and navigate any economic turbulence.
Exactly.
Okay.
Now, when we look at Agree Realty, their payout ratio is in the high 80% range.
That's higher than Realty Income, but still within a reasonable range for a REIT.
Yeah.
It seems like they're pushing the limits a bit more to reward investors with those juicy dividends.
They are, and that's a key consideration when evaluating their growth-oriented strategy.
Okay.
While their rapid dividend growth is impressive,
Right.
it's important to assess whether it's sustainable over the long haul.
That makes sense. If they keep growing at such a rapid pace, they might be able to maintain that high payout ratio.
Right.
But if growth slows down,
Yeah.
they might have to rein in those dividend increases to ensure financial stability.
Precisely. It's a balancing act. And to understand whether Agree Realty's growth trajectory can justify that higher payout ratio,
Yeah.
we need to dig deeper into their acquisition strategy.
All right, let's go behind the scenes and see how Agree Realty is choosing the properties that are fueling their impressive growth.
Well, remember how we talked about their focus on the most resilient segments of retail?
Yeah, the grocery stores, pharmacies.
Exactly.
Those businesses that are less likely to be disrupted by e-commerce or economic downturns.
And they've been laser focused on acquiring properties leased to these types of tenants.
Okay.
And not just any property.
Well,
They're
yeah.
targeting those with long-term leases and strong credit-worthy tenants.
So they're not just grabbing any old strip mall. They're being very selective about the properties they acquire,
Right.
prioritizing those that align with their vision of a stable and predictable income stream.
Absolutely. And this strategy has allowed them to maintain a very low occupancy rate,
Okay.
meaning almost all their properties are generating rent.
Which is good.
That's a testament to the quality of their portfolio and their ability to select properties with high demand.
So it seems like Agree Realty is taking calculated risks. They're pushing the limits with that higher payout ratio, but they're also mitigating risk through their strategic acquisitions and focus on resilient tenants.
Right. It's a high-growth, potentially high-reward strategy, but it's not without its risks.
Wow.
And that brings us to the elephant in the room,
Okay.
the broader economic environment.
Okay, let's zoom out from the company-specific details and consider the big picture.
Yeah.
How might factors like inflation, interest rate hikes, or even a potential recession impact these two REITs?
Well, remember, both Realty Income and Agree Realty focus on retail properties,
Right.
which are inherently tied to consumer spending.
So if a recession hits and people tighten their belts,
Yeah.
that could impact the revenue generated by these REITs, right?
It certainly could, however, the impact might not be equal.
Okay.
Realty Income, with its massive diversification across different types of retail and even some industrial and unique properties, might be better insulated from a downturn in a specific sector.
That makes sense. It's like the tortoise with its hard shell, able to withstand a wider range of environmental pressures.
Right.
But what about Agree Realty?
Yeah.
Their laser focus on retail, while strategically chosen, could make them more vulnerable to a broad economic slowdown.
Potentially, however, their focus on essential retail segments like grocery stores and pharmacies provides some degree of protection.
Right.
People still need to buy groceries and medicine, even during tough times.
That's true. But even those essential businesses could see reduced sales if people are really struggling financially.
Right.
And we can't forget about the impact of inflation on both companies.
Right. Inflation is a double-edged sword for REITs.
Okay.
On the one hand, it can lead to higher rental income as property values and operating expenses increase.
But on the other hand, it can also erode the purchasing power of those dividends investors are receiving.
Exactly. And let's not forget about rising interest rates.
Oh, yeah, those can have a big impact on REITs, right?
Absolutely. When interest rates rise, it becomes more expensive for REITs to borrow money to acquire new properties or refinance existing debt.
So Realty Income, with its investment-grade balance sheet, might be in a better position to weather rising rates compared to Agree Realty, which might face higher borrowing costs as they continue to expand.
That's a valid point. It's like the tortoise with its slow and steady approach,
Right.
having built up a strong financial foundation over decades. Meanwhile, the hare, while agile and fast-growing, might be more sensitive to sudden changes in the financial landscape.
So when we consider the broader economic context, it seems like Realty Income, the tortoise, might have an edge in terms of resilience and stability.
That's a reasonable assessment, however. Agree Realty, the hare, could still outperform if their strategic bets on resilient retail segments pay off and their aggressive growth continues unabated.
It's a fascinating dynamic.
It is.
But let's not forget that both of these companies are considered well-run and financially sound.
Absolutely. Both Realty Income and Agree Realty have demonstrated strong management and a commitment to shareholder value. It really boils down to aligning your investment choice with your individual goals and risk tolerance and how comfortable you are with the current economic climate.
Okay, so let's pretend we're playing investment advisor for a moment.
Okay.
To help our listener decide between these two REITs.
Right.
Let's say you're someone who needs a steady stream of income right now
Okay.
to supplement your living expenses or perhaps reinvest in other opportunities.
In that scenario, Realty Income would likely be the more appealing choice.
Okay.
That 5.8% yield is hard to ignore, and their long track record of consistent dividend increases provides a level of comfort that's particularly valuable for income-oriented investors, especially considering their lower payout ratio and strong balance sheet, which signal a higher degree of dividend sustainability.
But what if our listener has a longer time horizon?
Sure.
Maybe they're saving for retirement or a down payment years down the line. Would Agree Realty's growth potential be more attractive in that case?
It could be, especially if they believe Agree Realty can maintain its impressive growth trajectory.
Right.
If you're not reliant on immediate income and can afford to be patient.
Yeah.
Agree Realty's potential for rapid dividend growth could lead to significantly higher payouts over the long term.
Right.
Just remember that higher payout ratio and consider the risks associated with your aggressive growth strategy.
That's a crucial point, but we also have to consider the risk factor, right?
Yeah.
Realty Income, with its massive size and diversification across thousands of properties in various sectors, seems like a pretty safe bet. Is Agree Realty inherently riskier given its smaller size and concentrated focus on retail?
There's always a balance between risk and potential reward in investing. Agree Realty, while focusing on what they deem to be resilient retail, still carries more risk than the behemoth that is Realty Income.
This is where it gets really interesting because it seems like the market is already anticipating Agree Realty's future success. Their stock price reflects that potential.
Right.
So the question is that future success already priced into their stock?
That is the million-dollar question.
Right.
And it's a reminder that investing is not just about analyzing numbers and financial statements.
Right.
It's also about understanding market psychology and sentiment.
So how do we even begin to assess whether a company's stock price accurately reflects its future prospects?
Right.
That seems incredibly complex.
It is, and there's no foolproof formula.
Yeah.
But there are tools and techniques investors use to try to gauge whether a stock is overvalued, undervalued, or fairly priced. Things like analyzing price-to-earnings ratios, comparing a company's growth prospects to its industry peers, and even factoring in intangible qualities like the strength of its management team and brand reputation.
Whoa, this is getting deep.
Yeah.
We're going beyond the balance sheet and into the realm of market psychology and valuation models. This feels like a whole other deep dive waiting to happen.
It definitely is, and it highlights the fact that investing is an ongoing process of learning, evaluating, and adapting to new information. It's not a one-time decision, it's a journey.
All right, so to bring things back to our listener who's trying to decide between Realty Income and Agree Realty,
Yeah.
what are the key takeaways they should keep in mind?
First, remember that both companies are considered well-run and financially sound.
And they both operate as net lease REITs, which offers a certain level of stability and predictability in terms of income generation.
However, they represent two distinct investment philosophies. Realty Income is the tortoise, emphasizing slow, steady growth, a high current yield, and a lower risk profile.
While Agree Realty is the hare focusing on rapid growth potential for higher future dividends, but also carrying more risk.
Choosing between them depends on your individual needs, risk tolerance, and investment horizon.
And don't forget to consider the broader economic context, including inflation, interest rates, and potential recessionary pressures.
Absolutely. These external factors can impact both companies, though, potentially to different degrees. It's all about understanding how those factors might align with each company's strengths and weaknesses.
So before we wrap up this deep dive, I want to leave our listener with one final thought-provoking question that wasn't explicitly answered in our discussion today.
I love where you're going with this. Go ahead. Hit them with it.
What types of economic conditions would favor Realty Income's approach with its size diversification and focus on stable income? And what types of conditions would favor Agree Realty's approach with its smaller size growth potential and laser focus on specific segments of retail?
That's a brilliant question, and one that I encourage our listeners to ponder as they continue their research on these two compelling companies.
It's like we've given them a treasure map, but they have to go out and discover the buried treasure for themselves.
Exactly, and that's what makes investing so fascinating. It's not just about picking stocks. It's about understanding the forces that shape the world around us and how those forces might impact our financial well-being. And it's about having the knowledge and confidence to make informed decisions that align with your own unique circumstances and goals.
It's like we've handed them all the pieces.
Yeah.
Now they got to figure out how to put the puzzle together themselves.
Exactly. And that's what makes investing so engaging, you know?
Yeah.
It's not just about, blindly following recommendations or anything like that. It's about really understanding the companies, the market dynamics, the broader economic forces at play.
It's about becoming financially literate. And empowered to make decisions that align with your own unique goals and risk tolerance.
Absolutely. And remember, there's no one-size-fits-all answer in investing. What might be a fantastic investment for one person
Right.
could be a terrible choice for someone else.
That's why we do these deep dives.
Yeah.
We're not here to give you a stock tip.
No.
Tell you what to do with your money.
We're here to equip you with
Yeah.
the knowledge and the tools to think critically about your investment decisions.
Yeah.
And to navigate the complexities of the financial world.
And hopefully have some fun along the way.
Yeah.
Because let's be honest, investing can be pretty exciting.
It can be, especially when you start to see, your knowledge and efforts translate into tangible results.
So to wrap things up, let's revisit our central question.
Okay.
Realty income versus Agree. Realty.
Yeah.
Which one comes out on top?
Well, as we've discussed, there's no definitive answer.
Right.
It all depends on your individual needs, goals, and risk appetite.
If you're prioritizing current income, seeking a stable, reliable dividend payer with a long track record of success,
Yeah.
Realty income might be the more appealing choice.
Right.
They're the tortoises in this race, slow and steady, with a strong emphasis on diversification and a rock-solid balance sheet.
On the other hand, if you're comfortable with a bit more risk
Yeah.
and have a longer investment horizon,
Right.
Agree Realty's growth potential could be very rewarding.
Right.
They're the hair agile and focused, rapidly expanding their portfolio of high-quality retail properties.
But remember that rapid growth comes with a higher payout ratio
Yeah.
and potentially more vulnerability to economic headwinds.
Exactly. It's crucial to weigh the potential rewards against the risks.
Right.
And make a decision that aligns with your own personal circumstances and investment philosophy.
And don't forget to consider those broader economic factors we discussed earlier,
Of course.
like inflation, interest rates,
Yeah.
and potential recessionary pressures.
Think about how those factors might impact each company
Right.
and align with their respective strengths and weaknesses.
Absolute investing is not a static process.
Right.
It's about continuously learning, adapting,
Yeah.
making informed decisions based on the best available information.
That's right.
So we encourage you to continue your research on Realty Income and Agree Realty. Dig deeper into their financials.
Yeah.
And consider how their respective strategies align with your own investment goals and outlook on the economy.
And remember, the world of investing is constantly evolving.
Right.
What might be true today might not be true tomorrow.
So stay curious, stay informed,
Right.
and never be afraid to adjust your course as needed.
Absolutely.
We hope this deep dive has given you the knowledge and confidence to navigate the fascinating world of REITs and make informed investment decisions.
Yeah.
Thanks for joining us.
Thanks for having me.
And until next time, happy investing.
Happy investing. So